In this module, we're going to talk about some of the loan programs. It's going to be a fast module. I don't want to bore you with the details in there because there's some very boring details. But let's get into it. I'm going to explain a little bit about each one and give you an understanding. First one we're going to talk about is conventional lending. Conventional lending has the most popular guidelines and sets of rules. A couple of the things to address here. Most people think you use a conventional loan, you have to put 20% down. That's absolutely not true. It's not true at all. Conventional lending has a 3% down payment program. So you can come in, put 3% down. Your debts can't be as high as the people that are using FHA loans. Your debt to income ratio is generally going to be kept around 45%. It can go as high as 50%, but that's on a case-by-case basis. So don't think that you can't go conventional, because with 3% down, they have some great programs on that. Next one being FHA. FHA is the program. It used to be the go-to for down payment because you could get in for 3.5% down. Something to understand about FHA. When you get an FHA loan, you have to have mortgage insurance, even if you put 20% down. And you think, well, why would people put 20% down and go FHA? There's tons of other reasons. FHA lets you buy a house sooner after a bankruptcy. So people that had bankruptcy 3 years ago, they'll go with an FHA loan. And they may be putting 20% down. Something to understand with the FHA loan. They have an upfront mortgage insurance premium. What that is it's a funding fee. They're going to charge you 1.75% of the loan amount just to write that loan, just to do it for you. That's going to be something that's rolled on top of your loan amount. So know that there's that funding fee. There's also a mortgage insurance premium. That's your monthly mortgage insurance. That's going to be based on 0.85% of the loan balance. So it's set with FHA. It's also for the whole term of that loan. So if you had that FHA loan for 30 years, you're going to be paying mortgage insurance. On a conventional loan, if you have mortgage insurance, the mortgage insurance will generally go away after 10 years. 10, 11 years is a break-even point. And then you get to the 78% loan to value and it falls off, so you don't have to pay it anymore. With FHA, it's for the life of the loan. A side note on that, most people will be in a house, especially their first house, 3 to 5 years. Your second house, you might be in that 10, 15 years. Hardly anybody buys a house and they're in it for 30 years anymore. That was something that my grandparents did, my parents did. But yeah, for the most part, people aren't doing that. So it's not going to be a whole term, but still something to keep in mind with the FHA. On VA loans for veterans and active military, a couple of things I want to touch on. You have a funding fee for a VA loan as well. With that funding fee, it's based on how much you're putting down. It's based on whether or not you've used the VA loan before. It's also based on whether or not you have a VA disability. If you have a VA disability, a lot of times that funding fee is waived. With a VA loan, there's no mortgage insurance. So you can get 100% lending with VA, you can have your funding fee rolled on top of the loan, and you still don't have mortgage insurance. So the VA loans are really cool that way. Something else I need to touch on. With a VA loan, people think, well, I use my VA loan and I can't use it again. I have to sell that house and then I can use it again. I can free it up. That's not necessarily true. With a VA loan, you have a maximum entitlement. So right now the maximum is $453,100. So if you own a home, Midwest, back east, and you're fortunate enough to be able to buy a home for $75,000 to $100,000, and you want to move to Arizona, and you're going to spend $200,000 on a house, $300,000 on a house, because your prior VA loan was $100,000, let's say, you still have $350,000 in entitlement that you can use. You simply convert this home to a rental. It's still under a VA loan, but VA's got to know this is now held as a rental property. It was your primary residence. You didn't buy it as a rental. You bought it as a primary residence. Now you're moving to Arizona, but you want to keep it. You can do that. And you can go to Arizona and you can spend $350,000 on a house if you have enough entitlement and get another VA loan. So it has to be your primary residence. You can't go, I'm going to buy an investment property over here and use a VA loan. No, you can't do it. But under this situation, you're going to go there, you're going to buy another home to live in, and you can use another VA loan. A lot of people don't realize that, but you can, and it can be done. That's one of the advantages of having somebody stacking your team and having somebody there that knows what's going on and can give you this information, even if there are questions that you don't ask. Okay, we mentioned mortgage insurance, and you might be asking, what is mortgage insurance? Mortgage insurance is an insurance policy that covers the lender that's loaning you money on the house because you're putting less than 20% down. In order to let somebody come in with a 3% down payment and entice the lender to accept that, mortgage insurance companies have come in. You're paying for this mortgage insurance. If you stop making payments on the house and the house goes into foreclosure and the bank takes it back, the mortgage insurance company is going to give money to the bank to offset that difference in the sense that you didn't put enough money down to have enough skin in the game. So it's not an insurance policy that is going to pay you anything. It's to protect the lender, but you pay it every month. So you're paying it as an advantage to be able to buy a house with 3% down, though. So it's getting you in your home, and that's a good thing. Okay, I had mentioned debt to income ratios. Debt to income ratios, the amount of money you're making and the amount of money you're spending. Your car payments, credit card payments, and now a house payment. It's all figured in there. Generally, you want your debt to income ratio to be about 45%. When it gets over 45%, you have a case by case basis that we discussed on conventional lending. You might get accepted by it, you might not. And this is on an automated underwriting system. So it's something that happens pretty much instantaneous. You don't wait 2 weeks to find that out. If you don't get accepted and you're over 45%, let's say you're closer to the 50% range, then you look at FHA. FHA, pretty much all day long, if everything else looks good, you can do a 50% debt to income ratio. So people that have more credit card payments or maybe a couple of card payments and their debts are a little higher, oftentimes they need to get into the FHA lending because of the higher debts. And FHA is a little more forgiving on that. So that's it on the debt to income ratios. In regards to VA debt to income ratios, I've seen them go way over 50%. VA doesn't get real hung up on the debt to income as much as they look at everything as a whole. So again, that's a program for the veterans in the active military. So it's a little tighter community there, and it's just looked at differently. But for most of us, we're going to fall into the conventional or the FHA category. So 45 to 50% debt to income ratio. All right, that's it for this module. We'll see you in the next one.